I mean, it was clear to the Chinese that this was the most inflationary move they'd ever seen coming out of the dollar. So what do? They started stockpiling commodities.
Yeah, obviously, we're always looking forward to getting your views on some of the economic drivers relating to gold, etc., because we obviously all focus on gold. But what perhaps we should start by looking at the elephant in the room, which is, of course, the petro ruble, the blowbacks of the Russian centric sanctions are having on the West. And I know you've done some excellent work, read it on Zero Hedge a couple of times, two or three times now, recently been published a lot, because I think people look to you now for, you've included the history and how this all comes together. But what's your thoughts? Again, you mentioned the narrative. You question the narrative. We all question the narrative, and that's an important thing.
Yeah, I mean, my approach to this is very much sort of top down. I mean, from the very, very far top looking down. And if you look at the geopolitical dimension to all this, what we are seeing is we're seeing the emergence of superstates in Asia. And these superstates in Asia actually have a pretty good understanding of what the Americans are doing with their money. And I mean, we first noticed this back in March 2020 when the Fed went all in with zero interest rates, 120 billion a month of QE. I mean, it was clear to the Chinese that this was the most inflationary move they'd ever seen coming out of the dollar. So what do? They started stockpiling commodities. I mean, we're not just talking about copper, nickel, the dreaded nickel, but also grains. And so we've got a situation where even before Russia walked into the Ukraine or tried to take out Ukraine, China had the majority of the world's rice stocks, wheat stocks, maize stocks, and I think about 30% of global soybean stocks. So when this is for 20% of the world's population, now, very, very smart move, particularly with the benefit of hindsight. Now, whether they knew that the Russians were going to attack Ukraine or not, we don't know. But the effect of that is that this summer, there is going to be genuine starvation around the world. And the Chinese were protecting themselves from this. So China has already commoditized her currency in that sense, and you can see if you look at what the Chinese renminbi has done against the dollar since that March episode for the Fed. The renminbi has increased by I think around about 12% or so, or thereabouts. So there has been some protection there, not total. And China still has firepower to protect her own currency, which she has not yet deployed. And by that I mean undeclared stocks of physical gold, which she does not include in her reserves. And I estimated that could be as much as 20,000 tons back in 2002. And that was when the Chinese government then permitted the Chinese public, to begin to accumulate gold. They opened the Shanghai Gold Exchange and they even advertised on television, buy gold. And the result is that since then, roughly, I think just over 20,000 tons of physical gold has been withdrawn, in other words, delivered from the Shanghai Gold Exchange. So, we can see that I would say a minimum of 20,000 tons is in Chinese government hands in various sources. And also, you've got another 20,000 tons in public sources. Now, the public holding is probably 60 to 70% jewelry. So it's not monetary gold quite in that sense. But in Asia, as we all know, the Indians and the Chinese do regard gold jewelry as money, and there is very little premium, if you like, between jewelry and physical gold, and they use it. I mean, in India and Indonesia, there are networks of pawn shops who will take in gold as collateral for loans in of paper money. So what you get in India is you get the farmers literally, when it comes to sowing next year's crop, they need to buy the seed. How do they do that? They go along to a pawn shop with their wives' gold bangles and they deposit them and they get rupees back and they rush out and buy the seed. And at the end of the season, they can redeem it all back. That's the way it's worked for a very, very long time. And indeed in China, the word for money is the same word for gold. So, there you have it. This is a very different world from the one we have had from 1971 when Nixon ended or suspended temporarily, I think the word was, the Bretton Woods Agreement. So then we come to the situation over sanctions against Russia. Well, the first thing that happened was that when Russia walked into Ukraine, supplies from Europe's breadbasket to the rest of the world are basically compromised. And not only that, but that area is a huge producer of energy-intensive fertilizer, which the rest of us rely on to greater or lesser degree for the production of our crop yields. So you can see, going back to what I was saying earlier, that we are genuinely heading for starvation in parts of the world, and I mean not only in the LDCs, but also in major economies such as ours. I mean, the poor in this country, in Britain, are going to have a hell of a hard time in the summer feeding themselves and their families, between that and energy prices and all the rest of it. So that's not good. And then we had the sanctions. So the price rises which are being brought about by the sanctions haven't even hit yet. And I saw this morning that Germany's producer prices are up 30%. That's, this is in the pipeline now. And then there was the third bit, which I found interesting, and I'm still sort of digesting it really, and I'm writing about it for tomorrow's article for Gold Money, and that is that the sort of, if you like, the Central Asian bloc of ex-Soviet states plus Russia plus China are planning a currency to replace the dollar for cross-border settlement. Now, I think that will probably extend beyond that into the whole of the Shanghai Cooperation Organization, which encompasses, including India, Pakistan, Iran, China, and all the rest of it, all these very, very big populations. 40% of the world's population are in the SCO. Now, the one thing that they don't want is they understand that when the dollar's purchasing power goes down, because it is being debauched through issuance by the Fed, that there is a transfer of wealth from dollar deposits to the US government. Now, if you're a trader in the middle of Asia and you got a dollar balance and you see this going on, you say, hold on a minute, we don't want this. So this is, if you like, the driving force behind this new currency. The new currency, I mean, it's details yet to be properly released, but from what we can understand from the architects of this is that they plan to incorporate, first of all the national currencies in that bloc, in that Central Asian bloc, and also 20 odd commodities. Now, this is interesting because gold isn't mentioned. But I can see that from a purely strategic point of view, there would be a worry that if they say, right, we're just going to have we're going to introduce gold. I mean, remember that Sir Isaac Newton, back in 17, whatever it was, when he was master of the Royal Mint, reckoned that the currency, sterling, should be backed 40% by gold coin. 40%. It looks like they're doing a similar thing, not with gold, but wider commodities. So what's the difference? I mean, the difference is, from their point of view, that, if you've got one commodity, call it gold, that leaves, your new currency open to being manipulated by outside forces. I mean, we see this all the time, and you can give us chapter and verse, Andy, on the interventions in the gold market, and how, you know, the various sort of, if you like, state interests and all the rest of it just whipsaw the whole thing around. Bank of International Settlements, you know, the U.S. Treasury, whatever. So by having a basket of currencies, they are not exposed to that problem. I think that's the first thing. The second thing which we should note is that if you look at the purchasing power of the gold gram with respect to commodities generally, it's remarkably stable. I mean, it really is. The price of oil today in gold grams is 30% lower than it was in 1950. Now, you know, it's a similar story with all the other commodities. The volatility is in paper currencies, not in commodities themselves when you price them in gold. So a basket of 20 commodities, okay, there's room for them to fiddle around with it and all the rest of it. We can accept that. But you can see that they're designing something which is getting away from the Western currency catastrophe.